Welcome to the ROI Masterclass, the podcast where vision meets strategy and bold moves create measurable results. I'm Liat Siegel, interior designer and ROI strategist with 17 years of experience. I help businesses transform properties and ideas into high-performing assets. This show is specifically for real estate investors, hospitality operators, and boutique developers who aren't afraid to take risks, challenge the status quo, and demand a return on every decision they make. Each and every week, we talk with innovators and leaders across industries about the strategies and the insights and really all the unconventional thinking that turns potential into profit every single time. If you believe that smart design, decisive leadership, and strategic risk are the keys to real ROI, you're in the exact right place. Let's dive in. Welcome back to the ROI Masterclass. Today, I'm thrilled to introduce Hayato Hori, a multifamily real estate investor with a focus on acquiring and optimizing 20 to 100 unit buildings, primarily in the Midwest. Hayato brings a wealth of experience in leveraging creative strategies to maximize NOI and property value, particularly through affordable housing initiatives and innovative management approaches. Whether an investor, developer, or simply passionate about real estate trends, you'll find Hayato's insights on market dynamics, tenant retention, and value creation both practical and inspiring. Thank you so much for joining us today.
Yeah, thank you so much for having me. Appreciate it.
Amazing. So tell us a little bit about your background. How did you get started?
Yeah, my background. So I bought my first rental property while I was in college. It was the near end of my senior semester in college. I was trying to figure out what to do. I started multiple businesses within my time in college and really was trying to figure out what I wanted to do after. I developed like an app that was doing drop shipping and e-commerce and many different things to figure out what I wanted to do. And at that time, one of my business partners in college, where we started a small business selling like baby moccasin shoes, he actually started going into real estate. And I kind of saw him start from scratch his real estate business. And what he was doing was he was finding properties out of the Midwest that was maybe $40,000 or $50,000, but back then, putting maybe $15,000, $25,000 in renovations and flipping them to investors who wanted to buy turnkey rentals. And so from there, I actually bought one of his turnkey rental properties to see how that would go from the proceeds that I made during my other ventures in college. And I bought that property for $70,000. It rented out for about $750 a month. And fast forward a few years, I got hooked from the cash flow that these buildings produced. And immediately after college, I went to go work for a very short time, a company called Hyperloop Transportation Technologies. I loved the idea of it. It was the idea of Elon Musk introduced the idea of taking all the air out in a vacuum, putting a maglev train in there, and theoretically you could get from LA to San Francisco in like 30 to 40 minutes. I love the vision and love the people that I was working with, but I always still wanted to pursue my own dreams and ambitions. And so shortly after, I left the company and I decided to start my own real estate company just because I loved real estate so much after purchasing that first property. And from there, I started selling off-market real estate to institutional investors and retail investors alike. And I did about 250 of those. And what I saw while selling these properties to institutional investors was that one of them actually started the company pretty much at the same time I started my company. And I thought I was doing great selling, 10 to 15 deals a month. And I would make anywhere between $5,000 to maybe $15,000 on each property I would sell. And I thought I was doing pretty well. But then when I looked at how far these institutions went that were buying 10 to 15 deals as well on a monthly basis. Fast forward 5 years, they now had assets under management around $1 to $2 billion in assets under, where I was nowhere near that. And then I saw the effects of compounding and actually adding on to every purchase that you actually own and the compounding effect of it and the power of doing so. And beginning of this year is when we started Red Brick Equity, which is a private equity real estate fund. And I started that with my partners, one of whom, actually both of them, who started that company that I bought my first turnkey rental from in college. And so it kind of went full circle that way. And now we're acquiring multifamily buildings out in Chicago. All of our deals that we've done collectively, we've done about 1,000+ deal collectively, and all of them have been in the Midwest. So we know that market very, very well. And we decided to land expand into Chicago because we are very bullish in that market, third largest population in the US. And now we're just acquiring 20 to 100 unit buildings out there and continuing to compound just like the institutions that I used to sell to.
What do you think is the main difference for those real estate institution deals versus what you were doing? And what are the key learnings that other investors can take away? Just like, a franchise model versus the mom and pop models, right? What sets them apart is the systemization. What do you think is the main driver for that tremendous growth?
I think the tremendous growth that they have is they kept those properties. So one of the big things that I've learned is when I was selling these off-market deals, even my partner, when they were fixing and flipping properties, I believe they got up to maybe even doing like 50 deals on a monthly basis at that point. We would always have to chase and look for the next deal and next opportunity. And the efforts there wouldn't necessarily compound because you would sell 10 or 15 or 20 in that given month. You would have to go and identify and have a pipeline of another 15 to 20 to sell to keep the business running. And if you don't sell, your business stops running. And what we found out in the fund model is that you acquire and hold these properties for a longer period of time. So your efforts actually compound. So if I bought 4 to 10 buildings or properties even this year, and I bought another 5 to 10 properties the next year, now I have 10 to 20 buildings that compound on its own, and the rents continue to compound and the ROI continues to improve as well the longer I hold on to those. And that's what really clicked, at least for myself, on what it means to actually compound growth in real estate and what the economies of scales actually look like. And from there on, I decided that I want to hold these buildings and properties as long as possible and compound our efforts. And the best way to do so was through the private equity real estate fund and bringing in other retail investors who are accredited into the space so that they can get in on the ownership of these buildings and move alongside with them. And we quickly found out that it takes a village to make these transactions work and really scale the way we want to. And for us to do so, we have to give a huge portion of the pie, but we're fine with it. We can take a small portion of a big pie, and that's what we prefer.
I love that. Yeah, it's better to have something than not at all and share the wealth. I mean, I love what you said in terms of your partners. It's so important in real estate, especially when you're doing bigger deals, to have people, whether it's strategic partners or investment partners, there's so many moving parts that are constantly helping to make sure that you're hitting the highest ROI possible.
Absolutely. Yeah. And trust in partnerships, I think, is such a huge component of making operationally your company or your business work seamlessly. Because I've seen many businesses get hurt from partnerships and many frictions start happening if you don't have a good partnership in place. I've known my two other partners for about a decade now too and have worked very close with them throughout. And so we know how each of us complement each other in terms of skill sets and what we're actually good at, what we're not, get a support and help from our partners throughout that entire process. So we know exactly how each of us work and how much we trust each other in not only how we operate, but also how transparent we are with not only us as partners, but with investors. And I think that's a huge component because whenever you go into investments with anyone else, you have to have that trust and partnership and trust. And so that's a major component of, I think, how we like to move forward and continue on with the business.
Speaking of operations, is that what sets you apart in terms of bringing investors in with your fund?
Yeah, I think a lot of somewhat unique in terms of our fund structure and our thesis. I know a lot of operators and real estate funds and institutions have gone into the Sun Belt and they target those asset classes down there. However, we actually have been in the Midwest and there's not too many institutional funds and operators out there. We're seeing more and more of them come into the market as the data suggests that the Midwest is a very, very strong market and are severely undervalued still and have the potential to grow, continue on from there. So I think the fact that we are in the Midwest market and are providing that asset class to investors and going into B and C class locations where we are going into cash flowing assets that aren't really A-class locations where we have to speculate on rents. A lot of investors like that we're quite conservative on our underwriting and are going into areas where there is cash flow to provide distributions for because that gives a lot of people confidence that they're getting their checks on a quarterly basis, they're seeing returns, and then they have big conviction that we'll be able to hit those metrics that we're looking for in like a 5-year hold period.
You mentioned before, in terms of NOI, that occupancy is a major driving factor for NOI. Can you tell us a little bit about that and how you see mitigating those numbers?
Absolutely. So a huge part of what we track is occupancy and also whether or not, obviously, we're able to hit the market rents that we underwrote for. And if we can go, obviously, surpass that, that's great. And what we've noticed, and we've done the math on it, is for every dollar that we can increase rents for, it has a massive, massive impact in not only the NOI, but the valuation of the building, because the valuation of the building at the core of it is based off of the net operating income, the NOI. And there's only really two ways to improve it. One is to increase revenue, and the one other is to decrease expenses. And there's only so much you can decrease expenses as well. I think that's a component that every operator is looking into to see how they can reduce their expenses. But I think a big component is the revenue, because every single dollar that you can increase in terms of revenue comes down and directly affects the bottom line in the NOI, and therefore affects the valuation of the building, because you do the NOI, you divide that by the cap rate, and you figure out, what your building could be worth. And that has an exponential impact on it. So for every dollar that you can increase rents for, you significantly and exponentially increase the valuation of the building. So that's something that we always look at as to how can we go ahead and get a single dollar more on the NOI, though we take a look at how to make sure we do that without impacting like maintenance issues and difference, because we don't want to severely decrease expenses to a point where now we have maintenance issues that are coming up, the tenants are not happy, and then we reduce occupancy. So there's a fine art and balance. It's not just data on a screen. It's really more of an art to figure out what that balance is, to make sure that we're operating the property in an optimal level where we're getting the best rents and have the highest occupancies and have the most reasonable expenses and still have a very strong NOI to show for.
Yeah, absolutely. I mean, I think you said also in the last conversation that the occupancy, when you can drive rents, that's great and it impacts NOI, but the adverse effect is that revenue drops because occupancy drops, then it tanks the NOI.
Right, exactly. So there's an inverse there too. If you expect rents to be too high and you go for the moon, and now you have vacancy rates or vacancies in your building, that can significantly, again, impact the bottom line in your NOI. And there's many ways that other operators kind of going through that. So I know in the Sunbelt regions, there has been some more vacancies in areas like Houston, Texas, and Austin, Texas, and some parts of Florida as well, because there's just a lot of supply recently in the market. And the net absorption has been quite strong, which is always a good indicator. But because of that over influx in supply, at least for now, the rents have either stabilized or even come down in some markets. And so for a lot of sponsors and operators, the way they're combating that is through rent concessions, giving 1, 2, maybe even 3 months of free rent, but still trying to keep the rents on paper high. So they would say $3,000 for rent. So that's the market rent. They would give maybe 2 to 3 months, so the tenant feels like, oh, I'm only paying $2,500 or so for that rent. However, on the rent roll, they can still show that they're getting $3,000 per month in rent. So that's how a lot of operators are getting by and making sure that the building is still within that valuation and within the underwriting that they had initially. But occupancy is a major, major indicator of how healthy and how well the building is performing too. So that's something that we always take a look at, and also keeping track of like the vacancy and credit losses as well, and making sure that's within the confines of what we underwrote it for, because again, every percent, every dollar makes a significant impact into the building's performance.
I know that perceived value equates to actual value. I wonder how that also impacts occupancy, because once a landlord starts giving discounts, right, then you get them hooked. We just had Eric Gagnon on our podcast yesterday, and he was talking about the very same thing, where once you start giving a customer discounts they expected and they're kind of hooked on it. And ultimately, I think every landlord out there would rather not give concessions. Is there a world in which the property is positioned concessions so well that you can increase occupancy. You don't have to give concessions. Like whether it's through the way that it's strategically designed, whether it's finishes or the marketing of that building, how can investors kind of mitigate that and not have to give in?
Yeah, that's a great question. I think for us, we try to mitigate that by picking like the right market for it. And so, for example, in Chicago, the vacancy rates are extremely low. I believe it's at like 4.7% as of Q3 of 2025. I believe nationally, the vacancy rates are sitting around like 9%. And so it has very strong occupancy levels. And with Chicago being the third most populated city in the US, it really helps the occupancy. So as soon as we have, for example, in our building, there's a vacancy, we're able to get tenant applications within 1 or 2 weeks. So it's very quick and we're able to lease these units quite quickly. And we've also picked the sector in which we are able to have a lot of demand. So affordable and workforce housing type of units have a ton of demand, I believe. And we place Section 8 tenants into our buildings for majority of the times. And so with that, there's a huge wait list even in Chicago. I believe there's like a 7-year wait list to even be able to get those vouchers. And so the demand for these tenants in these units are extremely high. So we haven't had too much of an occupancy issue into our buildings. However, we always want to put our best foot forward as well. So in terms of the design and in terms of how we upkeep our buildings, we want to make sure that we are standing out in those aspects as well. So making sure the landscaping is done on a frequent basis. We don't want vines sticking out into our buildings and the tenants not really being comfortable coming back into ungroomed areas, right? And we're even installing like a laundry into one of our buildings because they didn't have it. And so we're putting that into the basement of our buildings. And we're actually not looking to make any revenue from that. We're putting a third party company in there for them to maintain and place those laundry units, but it's a convenience factor for the tenants and we want them to stay longer and have a high renewal rate as well. So there are many different things that we're kind of taking into consideration as well, not just the immediate impact into rent, but also how is it that we can make these residents feel like this is their home and keep them for longer as well, because the renewal rates do impact the performance of the building as well, and obviously helps maintain healthy occupancy too. So all of those things are things we also take into consideration above picking the market and city and the asset classes that we think have a major demand.
Yeah, it's huge, especially because it's more of a buyer's market now. Is that right?
Yeah, I know in many different markets there are buyer markets. It is a buyer's market, especially again in the Sun Belt region. We think it's a big buyer's market. I believe at the moment the average sale to date is like 60 days or so on the single family homes, 60 to 90 days in some of these markets. But again, it's very market dependent because, for example, in the Midwest and Chicago, homes are selling within 30 to 45 days, which is quite typical. And so it really depends on the city and markets, I think, that people are operating and going into. I think the Sun Belt region will recover and there's going to be a ton of growth there still. It's just a weird transitionary period at the moment. We've been also taking a look and we keep an eye out on all these different cities and markets as well to make sure that we're not missing any type of opportunities. But as of right now, at least for us, we think it's a little bit difficult to get into these areas even now. But as these loans come into maturity, we'll see what happens. Maybe there are more deals that come out that we can kind of jump into as well.
Yeah. David Priest said on one of our podcasts that when there's blood in the streets, then he knows it's a good time to buy.
Right. Right, exactly. It's unfortunate for the operators that, that bought it during that time, but someone has to be able to take care of those assets and provide those units. So it just has to be done no matter what.
We did a quick ROI analysis together on one of your properties, and there was a duplicate property next door. Somebody else owned it, and yours was doing much better. Can you share with us why? What did we find when we did that ROI analysis that really set your property apart and you were able to get better rents than the one next door?
So we typically put in newer appliances into the building. With these B and C class locations, we're not doing anything crazy. Like we don't have major amenities like having a pool or having gym in the units or anything of that nature. There's no comps that are within these B and C class locations that have those types of amenities, but we do try to make the units just a little bit nicer so that people are incentivized to come in and then really feel comfortable that they can call this their home. And so we do go in again and put in new appliances. We also make sure that we are able to have laundry within the building. Some of these buildings don't have laundry within their building as well. And these tenants have to go walk 10, 15, 20 minutes to even get to their nearest laundry station. Some even take trains and public transportation to be able to get to the laundry facility to actually do that. It makes a major difference in these people's lives. So wherever we can make financial sense of it, because at the end of the day, the building needs to be operating well. Otherwise, we don't have money to make these units nicer for tenants too. So it kind of goes in full circle. But we want to make sure that we're putting things into the building that does make an impact, not only on the financial sense too, but in the tenants' lives, because we know that will come and reciprocate back. So when we look at the comps of these other buildings, these are all the things that we take a look at to see that, hey, we're doing these things right. We're making it just a slightly better so that they have more of an incentive to come into our units.
Exactly. I mean, I hear all the time one of the biggest objections that I get is like, oh, interior design is only for like A-class properties or luxury. And I'm like, no. It is a marketing sales tool. Even if the changes are so slight, ever so slight, we saw that very, very clearly in the comp analysis that we did just with the property right next door to you, where we saw that your rents were better. You were able to charge more just because it was nicer. There was better curb appeal. It was taken care of better. We looked at the inside to see all of your cabinetry and your paint and your flooring and how that came together. And it does make a huge difference. It doesn't have to be a full-blown renovation, but like we said, even a little bit more on the rental income could have such a major impact on NOI. And the reverse is also true. If you don't take care of your building and you have high maintenance and your building is falling apart or it's not as nice as the one next door, you will lose ultimately that tenant or have higher occupancy and lower rents affecting NOI.
Absolutely. And you also get better tenants as well. When the tenants see that you take good care of the units, you're actually doing the maintenance on a monthly and very consistent basis. They see that too. And when you take care of their units, the tenants try to take care of that unit as well. And if the landlord doesn't take care of the units, then the tenant's obviously not going to care either. So it kind of goes both ways as well. And that's why we want to make sure that we take very good care of the building and the units, because the tenants then will take care of it as well.
Absolutely, right. Like attracts like, and it makes a massive impression on them. And I think ultimately you have less complaints. Yeah.
Absolutely.
What are you seeing as the next thing, the trend happening in the real estate market, and how can other investors mitigate uncertainty or challenges within the market?
Great question. We always like to underwrite based on current numbers. We don't like to speculate on what the numbers could look like and could be. So when we are doing our market rents and market analysis and seeing what the rents could be, we don't forecast that, hey, there's going to be a 5% bump in rents for the next year, so we should include that into our underwriting. We take a look at what rents are actually going for now. We take a look at what the rent rolls are going in the nearby areas as well. Because we underwrite so many deals, we kind of have a good understanding of what the rents are in a given neighborhood that we're acquiring into. And so we know what the rents can be and should be. And so that gives us also an edge on what we can actually offer if we know that it's severely under market rent too. Another thing that we always take a look at is kind of like the economic factors that are happening outside of our control, because we always want to make sure and take a look at what's going outside. Interest rates obviously impact real estate quite significantly, but other things that we take a look at is how's the job growth in the market, how's the population growth in the market, how's the job diversity, what sectors are coming up. For example, AI is a huge component of 2025, and what's more to come. I mean, Nvidia hit a $5 trillion market valuation, which is insane. And I think AI is only going to continue improving and getting better and making things more efficient. And in order to do so, data centers are needed as well. So we're keeping an eye out on where they're actually building out data centers, because if they do, those areas will also increase the valuation of those homes in those areas. So there's so many things that we kind of take a look at and determine and look at the data before we determine which city and market we really, really want to hop into and we want to really establish our footprint in. But as for other investors, I think just getting a good pulse of what's happening in the market. And also, I think a huge advantage that not a lot of people talk about is like the local relationships and strengths. We love the Midwest because we've stayed in the Midwest for a very long time and we have relationships there. And so that is a huge edge for us because we have these relationships that can take care of us when things go south or things go not according to plan. And we know that they can take care of us when these things happen because many of these things that we've experienced, we've gone through alongside with them on. And so I think having that robust relationship with these people that you work with on a daily basis is absolutely crucial into making sure that you have success in real estate. So I think that's that. And the last thing I think I would say is I think Ray Dalio said it as well. It's not so much what you know and what you can predict, but it's how you kind of react to the problems that are given to you. So the people who are able to take in a problem that comes in and really be able to make great decisions and act on them are the people who I think are going to be the most successful no matter what the economic conditions are. And I think that is a huge thing that we kind of take pride in as well, which is anything that happens, we'll go and take action. We'll figure it out from there on because no investor can predict everything that happens. It's just impossible. It's not human nature to be able to do so and speculate. If that was the case, then everyone would be very, very wealthy.
Yeah.
But that's not the case. So we do the best we can with the chips that are laid out and we make decisions based on the problems that come up and come up with the best solutions that we can at that given time and consult very smart people for it.
When you said that you don't speculate on, huge bumps in your underwriting, how does value add play in to that? Because that is a bump that will allow you to give a bump. And especially if it's done in a very strategic way where you can maximize that bump with the value add, how do you factor all of that in?
That's a great question. I'll give you an example. So for example, we are underwriting a building. We're actually under contract on one of them and the rents are severely under market rent. And we've seen some rent rolls in the area where let's say the 2 bedrooms are going for about $1,800 or so on average. And the current rent that this building is occupying at is around like $1,100. And so there's a major discrepancy, but these market rents are justified. They've already proven, it's proven that these market rents have been hit because it's already in the rent rolls and it's not just once or twice with many units that have been hitting these $1,800 on market rent. So there's history of these rents being achieved. Now, when I say speculating and forecasting, it's more so where we say, hey, we think we can hit $2,000 or $2,100 in rent because of the fact that maybe we'll do higher end finishes and be able to get a premium because no other unit in this area is doing so. And so we can take a gamble in making these units really, really nice and seeing if we can hit that $2,100 units and underwriting all the units to hit that mark. That's not what we're doing because we've never seen that happen. We've never seen it in other rent rolls that we've taken a look at. We've never seen it in the comps. And that's not what we underwrite for. And we don't underwrite for example, people might say, hey, the rates are now starting to come down. There might be some cap rate compressions that might happen. I don't know any operators are doing that at this given time. But if anyone says, hey, there could be a cap rate compression happening and we're speculating on that to be the exit, and that's why the IRR is that way. That's why we can achieve this IRR. Those are things that I don't like to look into because those things haven't happened yet. And it's purely based on not wishful thinking. There could be data to support it, but it's actually never happened yet. And so that's where I get a little antsy and not wanting to predict the future, if you will. I like looking at the numbers as it is today and making sure that we can hit those rents today because we've seen it already, if that makes sense.
Absolutely. What is the difference between somebody who they underwrite for that value add, they're not able to necessarily achieve that higher rent versus somebody who is able to hit those numbers? What is the difference between those two properties? What makes one more successful than the other?
I guess in terms of the value add, if they're not able to hit market rents and other rent comps prove and show and they've seen other rent rolls that these rents have been able to be achieved from many different buildings and many different managers, then the big question is, how are you kind of running your operations? And most likely the operations locally is just not good enough, just to be frank. Either they're leasing or their marketing or their tenant base that they're reaching out to is just not good enough. If they're not able to reach that market rent, or they don't have the connections to be able to hit that market rent either. So there are many different factors that could affect that. But usually when you see those market rents have been hit by many other buildings and by many other operators and you're not able to, then more than likely you just have to be really truthful with yourself and say, hey, I'm not doing good enough. There's something that I'm missing and I need to figure out what that is. And if you are able to hit it, then you're doing all the right things.
Amazing. Can you leave our audience with like one of your biggest tips when starting out in real estate, how to be successful, how to really win the game?
I think if I had to leave a very real estate specific and not keep it very general, for anyone who's wanting to dive into real estate fully on their own, and maybe they don't go with like a firm like ours or a syndication where, they don't want to be 100% passive, they want to do something on their own and have actual control of the asset, I would say make sure to have enough reserves. That's a mistake that I initially made because not having enough reserves and not having enough capital will hurt you significantly. Because in order for you to be able to get higher market rents and you're doing these value adds, you need to put in capex into your property, whether it's single family, whether it's multifamily. And then as soon as you run out of capital to do so, then you're stuck in a pickle. And you can always find creative ways, you can borrow money and whatnot, but it always gives you a sense of peace when you do have the reserve capital funds to make these improvements happen. So I think that is a big thing that everyone can kind of have in mind too when going into real estate as like a tangible thing that you can take. And for anyone else going into maybe the other side where they want to be fully passive, 100% passive, and want to invest in syndications or real estate funds like ours, I think the biggest thing is understanding, number one, the metrics that are given to you. What is an NOI? What is a cash on cash return? What is a cap rate, right? Having those basic fundamentals and understanding. And number two is don't invest in something that you really don't understand. You have to understand what you're going into. You have to align with the vision that the sponsor has as well. If you are gung-ho on new construction, don't go into someone who's doing a light value add and vice versa, right? There's many different strategies out there. You have to align with the vision and the thesis that the deal presents and really trust whoever you're actually working with. I think that's number three too, because you have to trust that that person is going to operate exceptionally and be able to have your best interest at heart at the end of the day, because you can buy a great asset, but if you don't have a great operator, that asset will never perform. So you need that part. You need to believe that that sponsor can achieve those metrics that they are and really make that decision for yourself at the end of the day. I know that was a lot, but those are the things that I'll look into.
That's what we're looking for a lot. We want to leave our audience with a massive amount of value, want to give a value add for our audience as well. Amazing. Thank you so much for joining us. If our audience wants to get in touch with you or learn more about your fund, how can they do that?
They can go to redbrickequity.com, or they can even reach out to me personally, Hayato at redbrickequity.com. Feel free to email me. I respond pretty quickly, so feel free to reach out whenever with any questions. I'm more than happy to help them there.
Amazing. We'll put your information in the show notes. Thank you so much for joining us.
Thank you so much for having me on. I appreciate it.